Hi, everyone. Jim Kruzan here, and welcome to the August edition of our Market and Economic Review. This will be a really quick video. Just wanted to give you a heads up on kind of what we're looking at and what's happening with the market over the month of August. To start by setting the tone, again, we think one of two things will happen. The data continues to weaken until we see a recession, or the data starts to improve, indicating some sort of a soft landing and an uptick. We are also hoping that the market broadens out. Remember, the last 2 years, it was an extremely narrow market. And if you weren't heavily weighted in Magnificent Seven or those big tech stocks, you really missed out on a lot of return. And certainly, we missed out on some return as to having a much more conservative portfolio. Valuations are really rich in that space. For those of us who've been around a while, it's somewhat reminiscent of the dot-com bubble and the extraordinary value assigned to certain technology stocks back then as well. So we're very data dependent. If we look at the economic data, you're still seeing softness in the leading economic index. The LEI, which I'm sure you're tired of hearing about, we've been looking at and reporting on for probably 30 months, and it continues to weaken. Some months more than others, but it's continuing to have its downtrend. If this were a soft landing or an improving economy, this would look like a Nike swoosh. Also, historically, we've never seen a drop like this without a recession. There's been no false starts, no big swoons and dramatic swings up, avoiding recession. So this is certainly cautionary and continues to be. Additionally, there are a number of data points that we see regularly that also are certainly pause for concern. Credit card delinquencies, that's kind of middle of the page, extremely high, 12+%, continues to remain high for the last several quarters, getting weaker, not stronger. That's something you wouldn't typically see in a robust economy. We're also seeing consumer mortgages on office buildings continue to be really weak, very high delinquency rates. And a whole lot of those mortgages are rolling over the course of the next couple of years. Again, looking at this from a perspective of, is this weaker data or improving data? And it certainly has been weaker. Beyond that, we are beginning to see some degree of inflation, although it's not robust. Both the PPI numbers, that would be the input or wholesale cost, and the effect on consumers. In fact, this past month, we got kind of diverging data. The PPI, which is the wholesale numbers, rose nearly a full percent, while the consumer numbers, those borne by the consumer, rose 0.3% for the month. Still high, on track for 3+% inflation, well beyond the 2% target. But it begs the question, why the dislocation? Are wholesalers or manufacturers absorbing the cost and not passing it on to consumers? In which case, that should have an effect, not a positive one, on earnings over the course of the next quarter or two. We'll see. Or are we going to see this get passed on, which would be even higher inflation and probably a change in consumer confidence and certainly their attitude toward spending in certain areas? Beyond that, we're beginning to see some weakness as well. Long awaited, long incoming, but some degree of weakness in the employment numbers as well. And as the employment numbers goes consumer confidence, goes consumer spending, et cetera. The initial jobless claims are being elevated. They're growing a bit over time. The unemployment rate is also growing a bit. Again, this is August data. We had an increase in the unemployment rate just last week, first week in September. And you're also seeing in terms of the job opening number or the number of jobs out there available, those are coming in a bit as well. Those are shrinking. All of these things, new employment, new first-time claims, they're all being elevated ever so slightly. Again, not what you'd expect if the economy is improving. Something to take a look at and certainly consider, and certainly be somewhat cautionary about, especially considering where stock market price valuations are. For many of you who we've done reviews with here over the last several months, you've heard a term that I've spoke about, the Buffett indicator. It's just a really quick rule of thumb that gives us an idea as to whether the market is expensive or not. Warren Buffett created this 60 years ago. Numerator is the value of the total stock market. Small cap, large cap, mid cap, utilities, technology, all rolled up. If you could buy every stock publicly traded, what would you pay? And that number is a little over $65 trillion. One input, the price that somebody is willing to pay for the market, and it reflects future growth, future cash flow, essentially future productivity. The bottom number is GDP, which is our productivity, sum total of all goods and services produced and consumed here in the US. There are three inputs. The US government contributes about 20% of our GDP. They have salaries, they have office buildings, they buy paper clips, etc. Publicly traded stocks certainly contribute for the same reason, salaries, etc., etc. That's about the third, 30-ish%. The vast majority is non-public private corporations, small firms like mine, large firms like the universities or Michigan Health System, where they employ 20,000+ people contributing billions of dollars to GDP. That ratio historically is about 80%. The value of the stock market is typically less than the value of our economy. And you'd expect so because the economy has vastly more inputs. Today, the value of the stock market is 217%, over twice that of GDP. Very expensive. And you'll see where we are today, historically at the highest valuation ever. And we'll see along the way over many years, peaks that end poorly where valuations come down. This is not a chart of the market. This is a chart of that ratio, stocks over GDP. And you'll see where those come down pretty abruptly. And here we are today at very high valuations. Historically, looking at this from a kind of a standard deviation point of view, we're really stretched out. Not saying it couldn't go higher for longer. The bubble can continue to inflate. But when you consider economic data that's questionable with valuations that are real high, it's sort of like considering the market or considering something with very little insulation, with absolutely no moat, unable to absorb bad information. And we saw a little taste of that a few months ago, right? In a very short period of time from February to April, the S&P sold off just 20%. Market was down like this, 15% on the whole year. And that was just over the tariffs. And then everything resolved when the tariff issues got kicked down the road 90 days. Unable to absorb bad information. And that's a big concern because that's how big drops occur and have in the past. If we look at our friends, the Mag 7, those big tech stocks involved in AI, we're beginning to see a little bit of a broadening out. This chart reflects the percentage that they represent of the S&P. That would be the first column. And you'll see that as of the end of August, those 7 contributed in terms of size 33.4% of the S&P. Over a third of the S&P is made up of just these 7 stocks alone. As they go, kind of goes the S&P. And that's why we've had these robust gains on the S&P that have really not been followed up the last couple of years in other indices, other components of the market. Kind of live by the sword, die by the sword. And at the very bottom of the page, you'll see I expanded that to the top 10 names, which is just a hair under 40%. I mentioned in meetings why that's important, because it gives some reference to the size of the bubble, perhaps. Back in 2000, before the dot-com bubble, the top 10 names represented about 20% of the market, 20% of the index. And back then, we were amazed at the degree of concentration the market had. Today, it's 2x. Going further left to right, you'll see the performance in August, and then the contributed return for August, what those individual companies actually contributed to the S&P. So as a result, the S&P was up a little over 1.2% for the month. Those 7 names contributed 62, almost 63 1/100%, or 52% of the return came from those stocks. That's still pretty concentrated, but not 70, 80, or 100% as we saw in the past. And as we look at year to date, carrying the same thing over for year to date numbers and the contributed return, it's even a little bit less, 46%. So what's happening? Well, tech isn't quite as robust as it was. Those valuations are starting to cool off. And when we start looking at performance or what really worked in the month of August, it was a lot of stuff that was not big tech. In fact, the NASDAQ itself was up less than 1%. The S&P was up about 1.9, but look at the Dow Jones, up over 3, or the Russell 2000 small cap index up 7, or a large cap value index up 3.5. Bonds were also up and continue to be up, but very slightly. It's been somewhat flat. There's still quite a bit of concern over inflation and what effect that might have. The US dollar continues to weaken, and it's down almost 10% on the year. And as a result, the international markets are up quite a bit on the year, up 20+%. And look at gold, up over or nearly 30%. So a 60-40 balanced fund, avoiding big tech, owning like the equally weight S&P, which is a good measurement of the overall health of the US market, and 40% in bonds or the Bloomberg or Barclays aggregate. That index is up above 5.8% on the year, about 1.9% for the month, up almost exactly the same as the S&P, with much better downside risk control, which is certainly something that we might want to consider with this dislocation that we have in terms of economic data and really rich stock market valuations. Well, that's it for the month of August. We'll talk to you again next month, where we'll conclude the month of September and the third quarter as well. As always, if you have any questions at all, reach out by phone, by email, what have you. We'd love to hear your thoughts. Once again, thank you so much. Have a wonderful remaining few days of the summer, although it certainly feels a bit like fall today. And we'll talk to you again real soon. Thank you.